Looking at major U.S. index, first, let's look at the chart at the right. You see Dow Jones, NASDAQ, and S&P 500. The recovery is so much quicker. The percentages are measured in the first 4 months of this year, and AI remains the main explanation for U.S. market resilience. Many institutions are more or less saying the same things. Goldman Sachs said that AI-related investments are expected to drive about 40% of S&P earnings growth this year. BlackRock favors AI and large cap exposure, and quality earnings have been a key support, meaning it's actually going well and not just a confidence in tangible sentiment. JP Morgan highlighted that U.S. earnings from tech and financials are strong. UBS noted that earnings growth is broadening beyond tech because consumer spendings are still resilient. But however, more people are becoming more selective in AI theme. UBS commented that the markets no longer reward AI companies with better managed CapEx numbers. It's been a growing trend that investors want evidence of monetization, CapEx being a long-term expense in a form of reinvesting back to the business. Investors want to see that amount of money spent back being monetized properly, and disciplined spending too. Basically, investors want to see returns from invested capital, and macro risks remain, especially rates. Inflation, because of what's happening with Strait of Hormuz and oil prices, we're already seeing prices starting to adjust upwards. Vanguard said that U.S. outlook is constructive, but expectations for growth are now slower, unemployment might be higher, and then firmer inflation levels. All these will put Fed in a tough spot to maneuver the interest rates. Zooming into S&P, it's now trading at all-time highs, yet there's no resolution in the U.S.-Iran war and no clear roadmap of next steps. Recoveries have become faster and faster thanks to the outsized liquidity and evolved market structures nowadays. It's easier to invest now. Historically, staying invested, despite geopolitical volatility, can yield long-term gains. Investors remember this. Hence, they're favoring the re-engagement. Look at the chart at the right. These are the numbers of days that S&P took to recover from a more than 10% loss. The most recent one, the Iran conflict, took only 11 days. The tariff tantrum last year recovered within 2 months. The same is happening elsewhere. South Korea and Taiwanese markets reached record levels. Emerging markets rebounded at an even faster rate than US. But not all is even. For Europe and Japan, despite the very quick rebounds, they continued to trade well below the pre-conflict peaks. See the chart at the right. The bottom two are Euro and Japan, and upper two are emerging markets and S&P 500. For Europe, it's very clear-cut. They're net importers of energy. So whenever there's swings in energy prices, they'll suffer the impact. They're very vulnerable to energy shocks, just like during mid-year 2022 at the peak of Russia and Ukraine war. Eurozone inflation jumped to 10.6%, and it took them a long while to adjust the level downwards. So for Euro region, the worry is more than just valuations. It's also the impact on earnings going forward. And one very big thing is they lack one of the key drivers in the stock market recovery, and that's technology weight, one that you don't see in Euro area, but prominent in US and China. Let's look at one metric on valuations of S&P 500. Although prices have returned back to high levels, but because earnings are also very strong, that pushed the price to earnings multiple from 23 times downwards to below 21 times, like you see at the chart at the right. And this is more prominent at the technology sector. This is good news. This adjustment appears to be healthy and not negative. Put it this way, you're taking price divided by earnings. Currently, the price is high, so the drop in the price to earnings multiple is because earnings are picking up, and it provides a relief from the excess valuations that are very high, built up previously. This is supported by the rising forward earnings expectations, which means there's a very attractive entry point. And earnings. The interim S&P 500 reports are showing positive news. Many were fearful that because of the Iran war, and that will bleed into corporate margins and investments and consumer behaviors. But earnings reports are showing the opposite. So there's a lot of faith in fundamentals. Currently, about 63% of the 500 companies in S&P reported earnings results so far. 84% have earnings above estimates. That's above the 5-year average of 78%. Revenue growth is also strong. It's on track for its strongest level since 2022. 81% of the companies are topping revenue estimates, and that's higher than the 5-year average of 70%. The picture at the right shows the breakdown of individual sectors. The tech-related ones are holding up well. consumer discretionary, materials, and financials too. So on to US. Prices have gone higher. March headline personal consumption expenditure gained 3.5% year on year. And looking at core PCE, excluding food and energy, that figure is lower at 3.2%. So obviously, when you include energy and food prices, these two are seeing a lot of impact from the high oil prices. The bulk of the price pressure came from goods and services. Both have prices increased. Energy goods and services had an 11.6% surge. On to GDP quarter one this year, US GDP gained 2% at an annualized rate. That's decent. Consumer spending slowed a little. Employment cost is a little bit higher at 0.9% quarter on quarter. So again, tech is driving most of the growth. This is a continuing theme. Software and computing investment rose 24% year on year, and all other business capex has contracted for 6 consecutive quarters. That's a good sign. And March durable goods orders are showing orders for computers and electronics posting gains at 3.7% month on month, 14% year on year. This will support the tech sector. Overall, data suggests that US economy is in reasonably good shape. But now the question is how fast the Strait of Hormuz disruptions can be cleared. Because the longer it persists, the more it'll weigh on the economy. On the Eurozone, quarter one this year's GDP expanded by a small 0.1%. The region is facing a lot of impact from the US-Iran war, reason being the nature of most Eurozone businesses, for example, automobiles, aeroplane defense, infrastructure, luxury goods, pharmaceutical, and even chocolate are all very trade-intensive. They're already facing friction with US tariffs, and now high oil prices are adding on more to the extra costs. April consumer prices are creeping up at 3% year on year. Energy costs have gone much higher at 10.9% in April. It was 5.1% in March. But when you look at the core inflation, taking away food and energy prices, which is pretty much zooming into services, that figure dropped to 2.2%. There are two schools of thoughts. Either services and firms haven't passed on the new costs from the high oil prices to consumers, or domestic demand is dropping already. You can see at the next slide that retail sales month on month declined. Look at the chart at the right. Euro area retail sales month on month aren't very strong. So next, there's a lot of concerns for stagflation. Efforts to control inflation using interest rate could cause a lot of problems because the region is facing high inflation and slow growth. If the respective central banks push interest rates upwards, this will have negative impact on growth. So in the next European Central Bank meeting, they're mostly going to hold interest rates steady at 2% and wait and see the impact from the Iran war. On to China. Overall, factory activities are still in expansionary zone. The Manufacturing Purchasing Managers Index surpassed analysts' expectations. Now at 50.3, anything above 50 is expansion, and whatever below 50 is contraction. Moving on to non-manufacturing, it fell into contraction. Both services and construction sectors shrunk. Then, when you look at the weighted average, the composite one, blending manufacturing and service, it dropped a little, but landed at 50.1, which is still an expansion. And lastly, this is not a new news. United Arab Emirates will exit OPEC on 1st May after nearly 6 decades. The attacks on the Strait of Hormuz have severely constrained the UAE's ability to export oil, and that threatens the foundation, the core pillar of UAE's economy. OPEC, Organization of Petroleum Exporting Countries, was founded in the 1960s, and these are the countries who are the members. To name a few: Iran, Iraq, Kuwait, Saudi Arabia, and now the leaving UAE. Notice that US is not part of it, and neither the Eurozone countries. OPEC have been artificially limiting supply, which influences the price of oil around the world. One example is 2022. Oil petrol prices were falling in America. See the chart at the right. At the vertical line, prices were dropping. Then OPEC said they would cut 2 million barrels of oil production a day, and immediately you see petrol price went up. Again, at the chart at the right. So, for UAE's point of view, and the Minister of Energy commented they have an ambition to achieve 5 million barrels per day of capacity by next year, 2027, and they want more freedom to pursue this goal. The departure from OPEC will give them more flexibility to respond to market dynamics. So next, this extra supply will very likely ease some of the upward pressure on petrol prices everywhere. including America.